silver is outperforming gold. Oh, yes, it got shin kicked in 1.5 days. I think it is a buying opportunity for those who might not have been in the first move. We're still going to probably $300 to $500 silver this year, much of that occurring by summer. Crazy as that sounds, it is not crazy. JP Morgan has now come out just recently and come up with the same number. Isn't that cute? But if gold went to the 8,500, that's all it does, match the prior bull markets. And silver went to 3%. Look what happened when silver got up to 93 to 95 a couple weeks ago. There was a fight. There were a lot of sellers there saying, swing objective met. Okay, boy. They got a little bit of sell off and then blew their head off, went to 121. So obviously the arithmetic scale, swing objective, is invalid because we went way beyond it. If you put silver on a logarithmic scale and add it to the top, it says $500. Why? Because the low of that range was $4 or $5. The high was 50. Tenfold dimension gain from bottom of range to top. Add tenfold to 50. Silver is outperforming gold. Oh yes, it got shin kicked in 1.5 days. That's how long that drop lasted, but 1.5 days. Now we spiked that out last week on Friday or so. We spiked out that low, but it quickly came back up. But most of the drop was literally within hours. Okay. Now people thought that's it, it's over, done. You don't have that kind of drop without a top. Our work says no. You did not break anything except sentiment. Long-term momentum trend factors are not even near points of structural breakage. Whereas in the past, when we made tops, 2011, for example, or the low in 2015, there was ample structure on momentum where you could look at a momentum chart and say, oh boy, you break that line, you're going down. Oh boy, break that line, you're going up. We don't have any structure nearby. And whenever you do not have clear bridge over the River Kwai type structure to blow up, to break down through, you probably aren't at a top. Almost all tops, I'd say 95% of them, have clear momentum structures that when broken, then you later find out price joins in. Anyway, so the answer to that question, yes, silver got trounced.
A rapid 1.5-day drop in silver doesn't equate to a structural top, despite widespread investor panic. Michael Oliver points out that long-term momentum factors haven't breached key thresholds, unlike 2011 or 2015 when breaks in momentum predicted declines. Most of the recent volatility resolved within hours, showing sentiment-driven noise rather than a fundamental shift. For portfolios, this means short-term reactions can be misleading, and chasing panic selling may erode gains unnecessarily. Institutional positioning appears largely unchanged, suggesting this is a minor correction, not the end of the rally. Next, we'll examine why this temporary shakeout might actually be a rare entry point for investors.
However, I think it is a buying opportunity for those who might not have been in the first move. And I think that we're still going to probably $300 to $500 silver this year. And probably much of that occurring by summer. As crazy as that sounds, it is not crazy. There's many examples of other markets doing similar type repricing to a new reality type events. Silver has all kinds of arguments for it, both technical and fundamental, that favor that sort of rapid readjustment. So our assessment says, yes, full thumbs up. This is a buying opportunity. In our weekend report, we put out some defining numbers where if we get above certain numbers this week, for example, in silver or gold, it says, yeah, you better get back on board if you got out. So yeah, I think that's the prime event of the year right there coming up.
So once again, your new target on silver is $300 to $500 by sometime in the summer.
The talk of $300 to $500 silver this year is often misinterpreted as hype, but underlying fundamentals suggest rapid repricing is plausible. Michael Oliver notes technical setups and macro trends support upward momentum, and history shows markets can adjust sharply to a new reality event. The comparison to other repricings highlights that volatility spikes are often opportunities rather than risks. For investors, missing the first leg of a move shouldn't deter entries, especially with institutional signals pointing to renewed buying. Monitoring key breakout levels this week may provide actionable clarity, And coming next, we'll break down how historical price ranges provide context for today's rally.
Cannot be any more precise, unfortunately. The tantrum type move that is, having lived in a half a century range between $4 and 50 back and forth for a half a century, while nothing else did hardly. Copper didn't live in a range that long. It lived in a similar range as silver did for 50 years. It remained in a range from the 70s, 80s, 90s, 2000 into about late 2005. Copper said, oh, I'm no longer going to live in a 50 cent to $1.50 a pound range, which is where it lived. Instead, in a couple of quarters, it went to $4.50. Bam. Okay.
Silver's half-century stagnation masks structural imbalances often ignored by mainstream commentary. Michael Oliver notes this tantrum-style volatility contrasts with copper's abrupt breakout in the mid-2000s, showing sector-specific dynamics matter. Long periods of range-bound pricing can hide systemic underinvestment or hoarding trends. For investors, the comparison suggests silver's breakout potential is historically consistent yet underappreciated, and portfolios oriented to industrial metals may miss asymmetric gains. Pay attention to institutional flows versus anecdotal sentiment. Next, we'll assess why silver's divergence from gold reveals deeper undervaluation trends.
No particular nuclear reason for it. It wasn't in sync with gold or silver at that point. It wasn't even in sync with other base metals. It just said, I'm going to a new reality. A couple years later, in 2007, lead did the precise same thing. Lived in a range for decades and decades. Said, oh, I'm out of here. Boom. Quadrupled in nearly a couple quarters. And if you look at gold, going back to when it was legalized 75, 50 years ago, it never stopped at its old highs. Made a high at $200 and went down, made a high at $850, went down, made a high at $1,200 almost, went down, and now we're, et cetera. So it wasn't confined in a 50-year box. Why was silver? Okay. Well, there's, explanations for that. Anyway, I think that not just the actions, prior archival actions of copper and lead, for example, or, look at the price relationship of silver to gold, for example. It's ridiculously low historically. In fact, last year, it was down 1% of the price of gold. Divide an ounce of silver into an ounce of gold. 1%. Okay. If you go back and look at the bull market surge that peaked in 1980, in fact, for a period of time there, not just a spike, it was at 6.5% of the price of gold.
Silver's historical 1% of gold value last year signals extreme undervaluation, even compared to prior bull markets where it reached 6.5%. Michael Oliver's analysis shows this isn't a random fluctuation. Structural shifts in metals like lead and copper illustrate how long-range stagnation can end abruptly. For portfolios, this gap highlights potential asymmetric upside, but investors should consider volatility and correlation risk. Media headlines rarely contextualize silver's historic underpricing, often masking the fundamentals driving this repricing. Up next, we'll explore how these historical ratios set the stage for potential multi-$100 moves in silver.
Okay. Then in the 2011 bull market, 2010 to 11, the latter part of that bull market, silver was over 3% the price of gold. So last year it was 1%. What do you think? It's going to free? Okay. So it's popped up over 2 recently, breaking out over a massive, clear technical structure on the relative performance chart, meaning an ounce of silver divided into an ounce of gold plotted each month. And you had a very clear ceiling, and it broke through that. So that's yet more evidence that silver is waking up even relative to gold. And yes, we had a sharper pullback than gold just recently, but it's still outperforming gold when you go back a year, 6 months, etc. So we favor silver over gold, and we think this is a buying opportunity.
And I'm sorry, your $300 to $500 target. That's quite a wide range, but that's based on a percentage.
Lots of things. Uh, First off, let's look at gold, the mama. It's had two big bull markets since, well, it got legalized in 75, and it was already at 200, and then it dropped down to near 100 by 76. Okay. From the 76 low to the 1980 high, it had an eightfold gain.
Headlines focus on silver's recent pullback, but relative performance charts reveal the breakout above a long-term technical ceiling. Michael Oliver highlights that silver's current ratio to gold, now over 2, signals momentum catching up after years of underperformance. Historically, silver reached 3% of gold in 2011, showing room for substantial gains. For investors, this suggests that even after short-term volatility, the trend favors silver as a portfolio enhancer. Short-term fear shouldn't obscure the structural opportunity created by breaking key momentum thresholds. Next, we'll examine how gold's historical bull market multiples provide a framework for silver's upside.
In other words, if you bought gold at the low, you made 8 times your money by 1980. Then it dropped and plateaued at a much higher level than it had been before. And in 2001, it made lows around $260. And it had an 8-fold gain to get to its 2011 peak. Different span of time, 10 years as opposed to about 3, but same dimension move, 8-fold. Okay. We made a bear low at 1,050 in 2015. We're now only 5-fold above that level. And yet everybody says gold's overbought. Heck, it hasn't even matched the performance it provided in the prior 2 bull markets under far less monstrous fundamental factors in play. So even if it just matched the multiple gain of those 2 bull markets, it'd be $8,500. And by the way, we've been saying that for a year, not as a target, but just as a get back to what we've done before type thing. JP Morgan has now come out just recently and come up with the same number. Isn't that cute? Anyway, but if gold went to the 8,500, okay, let's just say, okay, that's all it does, match the prior bull markets. And silver went to 3%.
Investors labeling gold overbought miss the historical context of its bull markets. Michael Oliver points out that gold's prior multiples, 8-fold from lows to highs, show the current price is only halfway in historical terms. Even with fundamentals more extreme today, gold hasn't matched previous surges, implying the potential for major upside remains. For portfolio strategy, this challenges conventional caution around valuation and supports measured allocation to gold and silver. Institutional benchmarks echo these historical ratios, yet media commentary remains fixated on short-term overbought signals. Coming up, we'll explore how silver's relative ratio to gold amplifies this multi-century framework for precious metals.
I mean, that's where it was in 2011. Okay. Whoa. What's that, 240 bucks, 250 bucks, something like that. Okay. I don't have my calculator. If silver went to the levels it was relative to gold in 1979, 1980, it'd be 6-fold above that level. Now here's another, and that projects up toward the 500 level. 2 other factors to look at. One is just simply monetary degradation. Look at an M2 chart. Go back to 1980 or 2011. See where the M2 was then. See where it is now. What's the gain? If silver were to match that gain, it'd be in the several $100s just to be where it was in real buying terms in 1980 or 2011. And there's another thing to look at. A stupid, simple price chart. There's 2 charts you can look at. One's arithmetic, meaning dollars on the left side. And you've got that 50-year range, and the thickness of that range is like a box, okay? It's a $4 to 50. Let's call it 5 to 50. So it's a $45 thick range. Added to the top of the range, $50. So
silver's potential isn't just technical, it's monetary. Michael Oliver emphasizes that matching historical M2 growth from 1980 or 2011 would put silver in the several $100 range, highlighting a hidden inflation-adjusted opportunity. Using both arithmetic and relative charts, the long-term $5 to $50 range underscores decades of suppressed pricing. Investors who only track nominal highs overlook how monetary supply and structural ceilings intersect to create asymmetric gains. This suggests careful allocation to silver now could capture upside while hedging currency degradation. Next, we'll review how recent breakouts defy conventional swing target assumptions and recalibrate expected returns.
When it broke out, your quote swing objective, orthodox method, would be $95. Look what happened when silver got up to 93 to 95 a couple weeks ago. There was a fight. There were a lot of sellers there saying, swing objective met. Okay, boy. And they got a little bit of sell-off and then blew their head off, went to 121. So obviously the arithmetic scale, swing objective, is invalid because we went way beyond it. Okay, but if you put it on a logarithmic ratio scale, just like I was talking about with gold, if you'd put that gold on a log scale, you'd see the eightfold moves of equal dimension on a log scale chart. If you put silver on a logarithmic scale and add it to the top, it says $500. Why? Because the low of that range was $4 or $5. The high was 50. That's a tenfold dimension gain from bottom of range to top. Add tenfold to 50. Okay, enough reasons, right? Okay, and usually these changes in reality where a market says, I did something wrong for a long time, I'm going to adjust it. You have a tantrum. You don't do it incrementally, crawling all your way up.
Standard swing objectives failed to predict silver's move beyond $121, illustrating how rigid arithmetic methods can mislead investors. Michael Oliver shows that a logarithmic perspective aligns with historical range multiples, projecting potential up to $500. Sudden tantrum-style corrections are typical when markets recalibrate after long underpricing, reflecting structural shifts rather than speculative frenzy. For portfolios, this highlights the importance of integrating both arithmetic and logarithmic analyses to set realistic expectations. Recognizing the dynamics of abrupt repricing helps avoid reactionary trading that could miss long-term gains. And what follows next is a deeper look at why these tantrums create strategic entry points rather than panic signals.
You suddenly burst to correct for the error before. You often will overdo what might be justified. So if, let's say, 250 or 300 is fully justified, then maybe they overshoot it. It's typical of markets that are correcting for excess. Anyway, those are some multiple reasons why we still assess that, nope, our assessment months ago, silver going into the hundreds. It's probably going to do it within a couple quarters. This correction occurred when? At the end of the second month of the surge. Surge defined by when silver broke out versus gold on a spread basis. That was the close of November. Okay, January, February. And then it has this correction. Earlier than we expected. We thought we might get one about midway into that 6-month period. But we still think by summer you'll likely be at very high levels.
Corrections in silver are often overblown in media coverage, yet they can signal healthy market recalibration rather than structural weakness. Michael Oliver notes that the current pullback is early in a 6-month surge that began at November's breakout versus gold, meaning the market is simply adjusting from excess momentum. Overshooting is typical when markets correct rapidly, and similar patterns occurred in prior multi-quarter surges. For investors, this suggests that patience through minor pullbacks could capture a far larger upside, reinforcing strategic positioning rather than panic selling. Next, we'll examine why gold's stability contrasts sharply with silver's volatility and what it means for portfolio allocation.
Now, one of the reasons why I've always had a larger weighting toward gold is because it's a lot more stable. And it's a lot more, the market itself is much larger and it's much more mature. And, to see gold move 10% in either direction is very rare. Whereas silver, we saw it it was up 70% in the first few weeks of this year, and then it dropped 30% in one day. And to me, that's kind of concerning. Are you not concerned by that kind of volatility?
Well, yeah, sure, but it's from an investment grade point of view. And I'm even talking investment grade like 6 months, okay? Uh, Silver is the place to be by every metric we can measure against gold. And it will likely outperform gold as it has. In fact, if you go back a year, it was 1%. Now it's 2. That means gold in relative value to gold over a year. So while gold's gone up over the last year since early 25 to the present, silver's more than doubled despite the pullback than what gold has done. Yes, with more volatility here.
Silver's headline volatility can be alarming, but relative performance tells a different story. Michael Oliver emphasizes that despite a 30% one-day drop, silver has doubled relative to gold over the past year, moving from 1% to 2% of gold's value. Gold's stability masks the more dynamic opportunity in silver, which remains an investment-grade option for those with strategic horizons of 6 months or more. For portfolios, this means tolerating short-term swings can yield outsized gains, especially when relative performance signals underappreciated upside. And what follows next clarifies why timing entry points in silver is far more critical than in gold.
But again, the key issue for investors is what was your point of entry? If your point of entry was finally, oh gosh, I believe it now, I'm going to buy it at 120. Okay, well, you got bagged, and maybe you should have been. Our buy levels were last June coming up toward 35, and at the close of November in the 50s. Those were our last two major buy signal levels. So yeah, we gave back some profits, but on the other hand, nothing alters our assessment. We shall see.
Now, I want to play devil's advocate, and
Okay.
as I mentioned, silver dropped 30% in one day, and the last time we saw a move like this was in 1980.
Yeah.
And on March
in the range, yeah.
On March the 27th of 1980, it dropped 63% in one day, and then
Wow.
in the ensuing months, we saw a lot of chop back and forth.
Yeah.
But long story short, it lost 70% of its value. You don't see that happening now?
No, I don't. If this were 6 months into the move, and if silver had reached $400 or $500 or something like that, I think you would have a sharp correction from there.
Timing remains the hidden factor that most investors overlook when chasing silver surges. Michael Oliver reminds us that entry points, not just trends, define outcomes. Buying at $120 differs dramatically from June's $35 or November's $50 signals. Historical context matters. The 1980 one-day 63% drop illustrates extreme short-term risk. But today's environment, earlier in the surge, makes such losses unlikely. For portfolios, reactive buying can erase gains, emphasizing disciplined entry. Recognizing historical parallels without overreacting is crucial for measured investment strategy. Next, we'll explore how current pullbacks create rare strategic windows rather than signals of collapse.
But not back to $50. The old reality's gone. The question now is, where is silver going to define the extreme upper end of the new reality? And I think it's going to do it very rapidly, meaning in a handful of months, not 3 years. And I think once it does, it'll probably overshoot and probably collapse from there. If you got in at $400 or 500. The issue is, did you get in at a proper time? And I think happens to be right now is the proper time. You've got to pull back, use the opportunity. Relative to what it's done over the last 10 years, it already has become far more volatile. I mean, we've covered $100 days here. 1 day, $100, sometimes 200, okay? So its volatility is off the page now too, relative to its normal behavior. And it'll stay that way, though it will lag what silver does in terms of upward dynamics. And I do think that, while gold has a 3,000-year tradition as money, so does silver, okay? And even India is remonetized silver, allowed for in bank transactions and all kinds of things. So it's not like it's a lost idea. Most people see silver as the industrial quote precious metal. It is in fact a monetary metal, has been for thousands of years, and it's being reborn because it's vastly underpriced relative to the mama monetary metal.
The narrative that silver is merely an industrial metal ignores its deep monetary legacy and structural undervaluation. Michael Oliver emphasizes that the current pullback represents a strategic entry, not a risk signal, as volatility now reflects decades of suppressed pricing breaking into a new reality. With $100 to $200 daily swings, markets are repricing rapidly, mirroring historical monetary metal behavior. For investors, recognizing silver as a reborn monetary asset relative to gold suggests opportunity in both wealth preservation and portfolio diversification.